Hello there, thank you for joining me, Fiona Cincotta here at StoneX. And today I am joined by Bertrand Oesterle, who is VP of Clearing and Execution Sales at StoneX. Thank you for joining me.
Good morning, Fiona. Thanks for having me.
So much going on, as there seems to be every time we're talking recently. Obviously, Trump's trade tariffs coming into effect. I mean, the big question here, if we think about what the impact could be, inflationary or recessionary, and tell me, how do you see this impacting the world of grains and oilseeds?
So it's been, as you said, a continuation of a very eventful week or a few weeks, and the economics of it is starting to become more divided, and people are starting to try to understand what is going on. Is it inflation? Is it recession? Is it both? So I'm not an economist, but I'm trying to digest it as the headlines come in, and I'll try to put it back into grains and oilseed as a context to see what we can look at to try to find out what it is. So to put it very simply, clients are looking for a white or black answer. The market is offering 50 shades of grey. So that's the difficulty at present. So from an inflation point of view, the tariffs mean that US goods, or I should say non-US goods that the US are importing are getting an extra tax. They're getting more expensive. That element of expense is either fed down the value chain or even to the consumer. It is the inflationary risk, and what we're trying to look at is if that inflation element is getting picked up by the index money. So index banks, index funds, if they want to hedge against inflation, they come to grains and oilseeds, they come to softs in order to buy our markets to try to have that hedge. So we will monitor over the next few months if that index money is changing or not. We think that they are already positioned, and we want to find out if that positioning grows or not. Now, on the recession element, if you feed back all those hikes of taxes down to the consumer might simply say, I'm going to reduce what I buy. There is a risk that you slow the economy. The recession risk is real, and that's really a long-term discussion for our clients. It's are we going to see a pile-up of stocks? Are we going to see a slowdown in demand? It's very early at present. It's very difficult to assess just right now, but I think the way we're going to do it in grains and oilseeds is to look at how the stocks move. Are they reducing as the season goes up in time as per normal, or are they not reducing as quickly? Do we get stock changes that make some countries more plentiful in stocks and others not? So that's going to be for us the element of study in order to try to find out that answer. And the other bit is that we may have both. It might be stagflation, so a sticky inflation and growth that is not going up at all. So the two could be the answer. This, when I said earlier on 50 shades of grey, provides a very opaque visibility on what's going on, and it hides a few elements which are very important to us. We mentioned in our previous discussion the US intention to put a $1.5 million fee on vessels from companies that bring a vessel to the US to deliver or take delivery of goods if they've got some Chinese vessels in their fleet. That, in a way, the market is also trying to find out, does it mean that the US need to drop massively their prices in order to take into account that freight issue and attempt to be still more competitive? So inflation, recession, and that unknown about freight.
So still plenty of uncertainty. And I guess then that really does raise the question then, are we looking at retaliation or negotiation? And what do you expect the impact and what do we need to understand when it comes to grains and oilseeds with that respect?
So it's absolutely correct. It's been very much a split between retaliation or negotiation. So we've had retaliation for a couple of weeks. So it's an escalation of those tariffs and counter tariffs. And it comes to a point now where we've reached a level of tariffs where some countries are simply saying enough is enough. So some countries are coming to the negotiation table. So we've had very harsh split between the retaliatory camp and the negotiation camp. So the retaliatory camp is obviously China. China is basically saying we'll get with the US on this to the end. So no letting down. And for us, it's been very interesting from a soybean point of view. So China is the #1 importer of soybean in the world. It consumes 98 to 107 million tons of soybean imports in a year. If China turns an eye away from you, that's it, you're out of their market. And that's what really is happening with the tariffs and the escalations of tariffs. We're now at 104% of US tariffs on Chinese products. That means that currently it's very unlikely that China will consume any more imports of US soybean. So it is interesting because it explains a bit better what we've seen since August last year. China has prepared very well for this situation. From August to March, China has front-loaded its US soybean imports. Some 6.5 to 7 million tons of soybean has been bought from the US in that period. It comes to a point where the tariffs are now on, and it's like, I've got some stocks, whatever happens, don't care. You have your policy of tariffs, we counter tariff. We have that 7 million ton US import as a stock. And at the same time, it comes at a point where Brazil is now about 90% harvested. We can turn simply to Brazil, get that freshly harvested soybean as an import origin, and we don't really need the US anymore. We can simply buy Brazilian. Also, the Brazilian crop had some uncertainty when it was planted a bit late and so on. Now that the harvest is well underway, 90% completed, we know that this crop is going to be big, it's going to be a record. So we're talking 168 to 175 million tons. So China is fairly comfortable from that point of view. It is a crop that is available, they can do without the US. So strategically, China positioned itself very early to prepare for those tariffs. Then beyond that, it comes to explain a bit better what we were talking about last week about the planting intentions. So I said to you, planting intentions have shifted in soybean in the US last year, 87.1 million acres. This coming season, expected 83.5 million acres. So why such a drop? Well, it suddenly makes total sense. If you're a farmer and you think that your first export market, which is China, is going to shut the door at you, well, why would you want to plant so much more? So it explains the drop in planting intentions. Then the situation is slightly different outside of soybean, because it means that in corn or in wheat, the world is much more interconnected. It's not reliant on one buyer. And so the shift in corn, which we talked about last week, from 90.6 million acres to 95.3 million acres, which is a huge figure, suddenly, again, it makes sense. Farmers going away from soybean because China is closing the door, going into corn because corn is much more of a worldwide flow crop than soybean in that sense. And beyond that, we've got the biofuel potential support in the US, and we mentioned it last week as well, the potential for bailout. So that bailout story needs to be monitored going forward as well. We know that it's been mentioned last week, and then the agricultural ministry came in from the US saying, hold on, we are talking of a bailout possibility. We're not saying it's happening. It may occur in a few months. So it's like the Trump administration is keeping its cards close to its chest and saying, we may not need a bailout. We might have some elements of export, some element of domestic demand that don't require a bailout. And in a way, it moves the discussion back from retaliation to potential future negotiation. It feels like the Trump administration is saying, China will eventually come to the table. And if they do, to negotiate, the goodwill would be to buy soybean. So we may not need that bailout. So it is that element of watching out what's going to happen. Now, outside of China, we've had a lot of smaller Asian countries which can't afford to not trade with the US. So the likes of Taiwan, Indonesia, and so on have said, we want to come and negotiate. Mexico, the same. The Mexican president has gained in popularity because she clearly said, I'm not going to go into a trade war with our #1 export partner. So negotiation table means what? It means that it gives a little bit of relief in terms of market understanding and saying some of it might be behind us. And then we've got the countries in between. So it can be Canada, the EU, for example, where there is an element of, oh, yes, we're going to retaliate, but we're actually talking. So Carney and Trump had a chat, and then the European Union is giving us a bit of a mixed message by saying the EU Commission is going to put that much on a portion of US imports, but that amount has now gone down. And then politicians in the US are saying, let's stop the tit for tat. We're not in that. Let's negotiate. So it is creating a difficult environment. It has had a massive impact on soybean. When those tariffs came on and the counter tariff came on, soybean dropped very quickly. We've got a gap on the technical analysis. Over the past 3 days, we've seen, despite the stubbornness of China in a way, we've seen soybean going up over the past 3 days. So there is an element of respite, and now we need to identify, is it a dead cat bounce, as we call it, or is it a potential expectation that we're going to come to a negotiation table that's wider than currently.
And talk to me about headline risk, and also how do specs and the trade position themselves?
So headline risk has been a massive element to try to follow over the past few weeks. I mean, obviously, we've had headline risk since the start of the Russian-Ukrainian war, so the market is slightly accustomed to reacting to headlines. But we've gone into madness mode in a way. So it's headline on, headline out, and we've had a perfect example this week. So earlier this week, one headline came out of CNBC saying the Trump administration will pause tariffs on all countries except China for 90 days. The market tried to buy back the positions to the point where it created technical issues. We had platform vendors who could simply not get the orders to the exchange, and for a while everything was paused. So it creates a kind of systemic risk which we have to be aware of. Clients were informed, clients informed their own sub-clients, and people just waited. And in the space of 5 minutes, that news was fake news. So in a way, the fact that people couldn't react wasn't that bad, but what if it hadn't been a fake news? So we are in an environment where we have to be cautious of those headlines. As I mentioned earlier on, clients want black and white, they get 50 shades of gray. Those headlines just make the picture much murkier. Now, in terms of positioning, it's been very interesting because we've seen a change over the past week. So I'm going to speak about what we call the specs, so the speculative positions, and also what we call the trades, so the commercials. So from a spec point of view, the longer it lasts, the better it is for their position, in the sense that we started to have those tariffs and those new spec positions, that new spec selling from about 5 weeks ago. In my opinion, it is a spec position that is slightly at risk, in the sense that we could see short covering if we have a fundamental story. We had mentioned it over previous weeks, but it becomes a self-fulfilling, prophecy, in the sense that the longer it lasts, the more you have that position for longer, and the more comfortable you become with it. So I still think that this spec position is vulnerable, but they've sold the tariffs, and they've been right to do so, because with the tariffs, we've seen the S&P, the NASDAQ, and all the rest fall apart and taking everything with it. But the vulnerability is something to watch. Now, from a trade point of view, I've mentioned before, the trade's been confused, has been frustrated, and we started to see a bit of a division in the way the trade is reacting. So previously we had mentioned that everyone in the trade had tried to limit the exposure to derivatives by doing a lot of AAs or EFPs, so exchange for physical. That has continued, but the shift or the schism we have now is that we've got some clients saying, until it's clear, until it's either black or white, I'm not trading anymore. So we respect that, you know, it's a risk-off attitude and we can't blame people for being cautious. But what we've seen as well is people trying to look to optimize. And I think that's what is very interesting, especially over the past week, because we've had people saying, soybeans gone up for the past recession, for example, but it hasn't been a straight line up. It's been down, up, down, up, down, up. That down, up myriad of movements creates opportunities. And some clients have tried to optimize their physical deal by trying to gain advantage of those elements of volatility intraday by putting in a very optimistic bid or very optimistic offer and saying, if I get filled, then I optimize my physical deal. So I think there's an element of trying to gain an advantage and a benefit from the current intraday volatility. And for me, that's very encouraging. It's very positive. Beyond that, we've looked at elements of optionality, which normally we don't necessarily do. So we've looked at strangles or we looked at condors. And it's interesting because normally, you know, traders will always take the mickey out of brokers to say that a condor is a broker's dream. It's 4 legs, it's 4 times the commission. But in a way, it's looking at a put spread and a call spread together, buying both in order to try to capture either one movement one way down or one movement one way up. So it doesn't tell us that volatility is away, but what it tells us is that market participants throughout those strangles or those condors or putting optimistic bids or optimistic offers, they are basically telling us we're not staying where we are. We're going to have shift, we're going to have movement. And for me, the positive attitude in this is to say, let's try to capture value out of those movements.
And what about the week ahead? I mean, what's expected from Thursday's USDA's monthly WASDE report, for example?
So yes, we have our monthly report. Now, in the past, I don't know, 15 years ago or so, a WASDE report, a monthly report from the USDA, would have been one of the major elements of volatility, and the market would be shocked if the trade had moved by 3.5 cents or something. Nowadays, it's among all the elements of volatility that we have, it's just another bit, and it loses some of its importance in terms of how much impactful it's going to be. But earlier on I mentioned that when we speak about recession, we're going to look at stocks. This report is a very good gauge for stocks. And it's in this report and in the next monthly reports that we're going to try to look very specifically at the US stocks and the worldwide stocks. Why? Because the worldwide stocks should show us if we have a lesser drawdown on stocks or a build-up on stocks when we should be using the stocks as we go across the season. Therefore, if we have that element, we can have an idea of whether or not we have recession. Also, when we talked earlier on about a larger expected Brazilian crop, we should see potentially a hike in world soybean stocks. So we have to, for this very specific report, we have to see if it stays constant or if the higher production is taken into account potentially also in higher stocks. Then when it comes to US stocks more specifically, we said that if the US are closing the door to China on soybean, for example, then what is it going to mean in terms of the export potential in wheat, corn, soybean, and how much is it going to affect their stock figures as well? So trying to understand if we have a recessionist element is going to be through those stocks. Now, beyond the WASDE report, we've got one big element that came out yesterday, and it changes a little bit the way that we're going to look at things in terms of the spec industry in Paris wheat. So we had mentioned that the bulls, especially the entrenched bulls, wanted to get the market to focus onto a fundamental potential issue through dryness. We had said that some of the specs or the bearish trade was saying last week that it might be in the rear mirror. The bulls are still saying it may play out in May or June. Now, yesterday we had a piece of news that came out about Russia. The third largest producing region of Stavropol had some snowstorms and hailstorms. So snow means more moisture. It means that dryness issue loses a little bit of its shine, but hail means damage. And the interesting bit was that with all the tariffs, the specs, as I mentioned in previous weeks, have gone very large as a short in Paris wheat, with some 258.1 thousand lots short across May, Sep, Dec mostly. We are going to get an update from Euronext later on today. We think that position has been reduced this week, and I'm going to try to explain why. So first of all, we had mentioned previously that May is the last month of the old crop. Sep, Dec are the first 2 months of the new crop. We knew that for a long time the spec position was very much front-loaded into the May. We have seen evidence that the funds have rolled out of May into Sep or Dec, and we had discussed that through the May Sep, for example, where we've seen the May Sep going from minus 250 to plus 0.50, and then we said it had gone to plus 4, it's gone up to plus 650. So we've seen that roll happening. But what was interesting yesterday is that through the analysis of the open interest against that massive short position, we estimate that there are shorts still in May, but also in Sep and Dec. And yesterday, when that Russian hail story and damage story came out, we saw Sep and Dec new crop go up. So that comes to comfort the bulls for the wrong reason. It's not dryness, it's hail, but it is an element that is pushing the new crop, and it reduced naturally the May Sep spread from 650 to about plus 4. But the interesting bit is that the OI from yesterday to today has reduced in May, in Sep, in Dec. So it indicates that those specs exited, they didn't roll. So later today we're going to look at that 258.1 thousand lots to see where it is. There's always a bit of a delay. We might have to wait for next week's data to see how that exit impacted that figure. But it goes back to what I was saying earlier on. The specs are trying to do their own prophecy by staying into their short. That short, as we mentioned before, can be vulnerable to short covering risk because of a fundamental issue. That fundamental issue initially was thought to be dryness. It might be hail. And then we're going to have to wait for the assessment. It will take a while for Russia to come back and say, we've lost X amount of millions of tons, or not at all, or much more. We've had, interestingly, one of the farming lobbies in Russia yesterday saying that if this event is followed by dryness, we could lose 30%. So, I mean, a farming lobby obviously is going to give us some very bullish news, but it is putting a context where we have to be cautious of what the facts are, how we react to headline. And yesterday was a prime example of looking at new crop going up because of an exit, and we have to be cautious later on to see how the analysis of the actual and real damage is going to change that spec position and comfort or not comfort the bulls or the bears in the trade.
Excellent. I mean, Bert, you've given us clarity in a very uncertain outlook. You've given us ideas to be watching for next week. So thank you very much for joining us again today.
You're welcome. Thanks for having me.
For more videos like this, please do like and subscribe.